Welcome. Today we have Travis Thomason, a partner here at Richey who specializes in the alternative investment space, audits of alternative investment funds, VC, PE. He works on hedge, crypto, and also with us is Joe, Senior Vice President at Houlihan. He's a valuation specialist who works in the VC space with an emphasis on crypto. They've been doing this for 8 years or so. Today they're going to talk a little bit about valuation of digital assets, some common kind of pitfalls, and also some best practices as it relates to valuation, valuation policies, information gathering, items like that. So to kick it off, can Joe and Travis, do you mind talking about some challenges that you both see in the valuation space, particularly with digital assets?
Yeah, sure. I'll kick it off, Travis, and then I'll kick it to you. I think one big challenge for our clients is just information asymmetry, and just the difficulty in kind of acquiring, updated information and dealing with incomplete data. We see that a lot. It's a challenge from our end too, right? We try to get our clients to be in constant communication with their portfolio companies and the management teams of their companies, because really at the end of the day, we are working with them, for them to try to get to a solid valuation mark. And it's very difficult to do that without enough information. There are some ways to try to work around that, but, I think that, having, best practices in the space, right, is to really just be constantly communicating with them, whether that's, on a quarterly basis or even more frequently, to try to get financials, get operational updates, hear information about developments and key personnel changes, things like that can add to the qualitative support of a given mark, based on how things have changed over time. So that's one thing I noticed. I'm sure you have a few more, Travis, to talk about.
Yeah, I think some of our big issues relate to that. Expecting clients. I think we go into an audit at the end of the year, and if we haven't communicated up front our expectations on what the clients need to be doing on valuation, far too often we run into, clients only doing valuation at 12/31, and so setting the expectations early on that, at a minimum, it's got to be at the end of the year, preferably, clients are doing quarterly valuations and they're reaching out to, like you said, their underlying portfolio companies and, figuring out latest rounds of financing, how this company's doing. Are there any, issues in the market that could affect the value of, the company or going concern, even if there isn't a latest round of financing. Oftentimes there can be years between, round of financing, but that doesn't really mean that there hasn't been some change in what that value might be. So, staying on top of what's going on with, the company. There's definite situations we've run into where there's no latest round of financing, but maybe a founder has left, or there's a large change in the team, and that's something that definitely speaks to potential change in value. That could be an issue that necessitates a write down. So really having those managers constantly involved, and I think from an audit perspective, us really setting that expectation of the timeliness of checking the valuations of those portfolios. And in addition, or I guess it kind of goes hand in hand with checking that valuation as an auditor. We need and expect the portfolio managers to have a detailed write-up specific to each investment. Obviously as a fund manager, you've got to kind of have an overarching methodology within your fund that speaks to how you're going to value equity and SAFTs, or whatever your position is in the fund. That's kind of an overarching methodology, but then that doesn't really cover each individual position. So you've got to go in there and really analyze what's going on with each position and give us a write-up of why, whatever you've marked it, why that's appropriate based on looking back to your methodology fund, and then drilling down to the specific position and why that's appropriate. And I think oftentimes I see managers just kind of kick back to the overall, this is our methodology for the fund, right. And say this kind of applies to every position in the portfolio, but that's not really the analysis that we're looking for on a granular basis.
Right. So these blanket coverages, right, just suggesting that we are valuing all of these investments based on this procedure because it's just the way it's in our policy. That's kind of what you're trying to avoid, right?
Yeah, exactly. I mean, like in the private equity space, it's great when there's, a round last year and you can market to that round, but there's often a significant lag in rounds. And far too often, you see managers just leaving it at cost. Really cost isn't an approximation of fair value. You can say most recent transaction, that approximates fair value, but you should, as a manager, kind of get away from saying cost is reflective of fair value, especially under the accounting standards and fair value standards that we're required to audit under. So, yeah, really sourcing a lot of information around what's going on with each of your underlying positions.
Right, and maybe I'll add to that. And you can correct me if I'm wrong here, but cost can be valid, right? I mean, cost can be a valid fair value mark. It's just you have to be able to support it. You can't just say this is cost because there hasn't been a round, or that's not good enough. And I think that's kind of the process of where outside valuation specialists can come in and try to at least frame the narrative a little bit about what the auditors are looking for. Right, we have a ton of experience. Houlihan Capital does of working directly with auditors and kind of understanding. We have plenty of people on the team that have been former auditors, and so understanding the questions that are asked and kind of the information, even if it is qualitative in nature, I think it has to be more robust than just pointing towards a policy and saying this is the way we do it and this is all we have, right? And that's where it seems like that sometimes people can throw their hands up and maybe they don't have experience doing that, right? But that's where that constant communication and understanding that there are professionals in the space that can help you out.
Yeah, and I mean, ultimately it's management's responsibility to set these valuations, but it doesn't mean every manager is an expert on accounting rules or GAAP compliance and everything they need to do, which is obviously where you guys come in and provide a lot of value there. So there's options for them. I think the main thing from the management standpoint is they're aware of what they need to be doing and they're staying on top of sourcing that information and staying on top of performing these procedures in a timely manner, whether it's something they have the expertise in or they need to reach out to other sources to help them with those valuation marks.
Yeah, it becomes an intense job, right, for a lot of these fund managers to kind of track. Some of our clients have upwards of hundreds of investments, right, and to try to I'm sure you do too, and so to try and be on top of all those, it can be a full-time position for someone internally, and that might not even multiple full-time positions. And it's tough to keep it all in house and know exactly what you're looking for. So that is kind of where that outsourcing can help out tremendously. Right?
Yeah, absolutely. I mean, just knowing from auditing these funds and the amount of work we put into valuing portfolios at your end, it's a lot of work for the fund managers to stay on top of all that. Definitely.
Right.
So along those lines, you mentioned a lot of work with the fund managers. Do you have any suggestions on best practices for information gathering from portfolio companies? What are we seeing clients do that work well or works well, doesn't work well? Anything along those lines?
Yeah, I think I touched a little bit on it too earlier, Matt. Was just a little bit more of just the constant communication, right? Of being connected to them, like having a direct line, having kind of updates, whether that's conversations that you have at a given time of year, or you just kind of doing outreach on a frequent or periodic basis, whether that's quarterly, monthly. And monthly might be a little bit too much, right? There's a balance to strike between not wanting to really bother them and help them. You want to be there for them to grow the business, right? You're an outside investor, but at the same, and you might not have all the rights available to you, right? There are minority rights available here that can hinder you from really getting stuff. And I think that you're finding more and more, especially in recent years as to the early years, where companies understand that they have to kind of be a little bit more transparent in their information. I think in the earlier years of crypto, the ethos of libertarian and not wanting to share information, there was a little bit more hesitation there. But I understand that it seems at least that most entrepreneurs and company founders are understanding that for this place to get big and legitimized, they have to start sharing a little bit more information about their operations, and so you're seeing that, but you're not going to get it until you're really asking those questions and really communicating. So that's kind of what it's just a frequency thing, and understanding the right questions to ask, and working with your auditors and your valuation specialists, right, and your team to be asking those on an ongoing basis.
Yeah, I mean, I've seen so much improvement in responsiveness, just from the audit side in the past, 5-6 years. I haven't worked in the space for a while. It was definitely difficult early on. It's gotten a lot better.
Yeah.
But just to the point about constant communication, as a portfolio manager, I think really setting the expectation with your underlying companies that you're going to be needing to get information from them early on. I can just tell you from experience, we've got clients who are highly involved, constantly, talking to their underlying portfolio managers, getting updates, figuring out what's going on. And those audits are so much faster, so much more efficient. Typically the confirm process is way faster. Managers who are not as on top of, checking in with their underlying portfolio companies, oftentimes, if we're sending confirms, those companies, maybe they haven't heard from the manager and now they're hearing from us, and there's no expectation of flow of information. So those audits absolutely tend to drag on forever, just because, the manager hasn't set that expectation up front of that flow of information back and forth. It becomes very difficult for us to then get any the information that we need to perform the audit. So, just along with, having timely and correct valuations with that, information flow, it's just the easy of the audit process once that expectation is set.
Great.
What are some ways that you guys deal with incomplete or limited information? Travis, for you as an auditor, and Joe, you as a valuation specialist.
Yeah, I think on the valuation side, so there can be instances where you aren't able to get as much information as you like, right? I think in some of those instances, there are some ways around that, just trying to lean maybe more heavily on an approach like the market approach, for example. I'm thinking in a valuation sense where, it's a combination, that the analysis can be a combination of company-specific information, plus, a more market approach, heavily market approach, methodology, and incorporating as comparable analysis, for example. You might have to lean more heavily on that rather than some of the company-specific factors, because you're limited in actually how much information that you have and what you can imply directly in that company. So, in that instance, yeah, I mean, you're more heavily weighted towards other benchmark assets or other comparable companies, other comparable tokens, as opposed to the direct inputs from the company, and it tends to be a little bit less, complete, I'd say. But at the same side of that token, we're all doing what we can, right? I mean, if the questions are being asked and you're trying to find out as much information as you can, there are some avenues around that. It just makes it more challenging. It doesn't. Everybody doesn't feel as good about where we're coming out at. There are some challenges. That the auditors will ask questions, and really at the end of the day, you're on the hook if you aren't asking those questions, right? If you come back and you say, well, I did this analysis, kind of goes back to what we were talking about earlier. If you're just throwing your hands up and saying, well, this is the way it should be. We didn't ask any questions. We're not doing our due diligence. That's when you can kind of get in trouble. And so you have to at least be asking the questions. And building that rapport. And I think it starts from the get-go, right? I think you mentioned it, Travis. It starts from when you make the investment and setting those expectations that, I hope to be asking, about constant updates and how things are going. So it can be a challenge for sure. I think that is one of the bigger challenges in the space with, a number of investments that some clients can get into. But you have to build structurally your process in a way that you are asking the questions, you're getting as much information as you possibly can.
Yeah, from the audit perspective, I'd pretty much echo, everything you said there. There's obviously situations where maybe we don't have information right, so there's limited direct information from the underlying companies. But, the answer in those situations just to, throw up your hands and, be like, cost is real, reflective of fair market value, and then not doing any additional analysis. it's not to say that the information from, market data or comps or, whatever you would use to try to build a relevant value is as good as direct information, but, you do need to go that route, and you do need to, either do it yourself or work with an expert, or, go beyond just, saying cost is fair market value and there's no direct information, so we can't do anything else.
Right.
That additional analysis is very important, especially from the audit perspective.
Great.
Can you talk, you mentioned this a little bit earlier, but just curious if you can go into some more specifics on the importance of having a formalized valuation policy or set of procedures, and some of the best practices that you see in those, and the ones that work well.
Yeah, I mean, for any fund manager, really a starting point probably when you're launching your fund and going through your organization docs and working with legal is really setting up a framework for how you're going to, value your portfolio, depending on, what's in your portfolio. It's equities or, digital assets, marketable securities, SAFTs, whatever it is. Having a consistent framework, I think the most important thing within that framework is making sure you're not cherry picking different methodologies for different positions. When we're looking at a fund consistency, and, whatever your policy is, is the first and most important thing. Obviously there can be differences in, how a fund is going to, potentially value different positions. Obviously there's some expected standards, but there's some nuance, funds can have there. But the main thing is really that consistency across the board, making sure you don't, cherry pick one equity position and value it a different way than, another equity position. That's definitely going to be a red flag for us.
Yeah, I would echo that too. I think it's important to remember that, again, I think this is a constant theme, but just throwing your hands up and saying that because it's in the valuation policy, this is, the truth, and this is the only truth. You want to have consistently apply these policies and procedures, but you have to be, careful. You have to look at each situation individually. You have to evaluate, does this make sense? And just because, you're relying on this as a blanket coverage for a given, investment, does it all make sense for, every single situation? So just take it by a case basis. You want to have a robust policies and procedures document in place. But remember not to just lean on that in every situation. Really evaluate each position and, how that's changed at a given valuation date.
Yeah, I mean, you can definitely update it. I mean, I definitely work with funds where, there's a reason they're going to need to update their policy. It's not necessarily a static document or static set of policies, but you definitely need to have that framework and have that clearly outlined.
So a specific question related to the valuation policy. What have you seen as far as best practices go for valuing block tokens when the token launches and is publicly traded now?
Joe, you want to take that?
Yeah, I think this is an interesting and evolving perhaps situation. I still believe valuing it with a put option pricing model and trying to estimate a DLAM, discount for lack of marketability, is the proper approach. To me it really encapsulates kind of the true discount of what you're trying to apply. And right, it's taken from traditional finance, modeling out an insurance contract on to get the price of the put option, for some restricted period, right? And so it comes from the traditional financial world. It is a new, obviously, asset class as a whole, and so there are some differences, obviously some nuances involved there, potentially different put option pricing models to use. These are very volatile assets, right? So there's nuances involved all throughout it, but I think that generally that's a best practice that we see. I don't know if you're seeing more and more differences there, Travis, or not, but
no, I mean that's exactly in line with what we would expect to see, on those types of assets. Obviously, there's no specific guidance, unfortunately, on those, with the current framework and current guidance out there, and hopefully that comes in the coming months and years. So there's a little more clarity there, but with a SAFT type instrument, where you have a portion of tokens that are locked up investing over a time frame. Exactly what Joe said. We would expect to see some sort of analysis of the time frame of those tokens vesting and how long the lockup is, and some sort of discount applied.
Do you see curious, do you see differences in the frequency of your clients kind of applying that approach? Or, I mean, obviously, since these are, traded or actively traded, would you expect to see that on a monthly basis, or is it kind of just dependent on the fund's policy or how comfortable they are?
Yeah, you mean as far as like resetting the discount on a monthly basis as
Yeah, I guess updating an analysis, right, on a monthly basis, quarterly basis. I would think it's more frequent than annual, just because they are obviously actively traded, but depends maybe on the fund's policy.
I think it really depends on when funds are closing their books. Obviously we've got hedge fund structures that close their books on a monthly basis, and definitely in those cases they're updating that monthly to match the the books being closed. In the case of a closed-end private equity fund, it might be a little less often, just because maybe they're doing books on a quarterly basis. So, they're doing it at that point. But, definitely, if you've got a closed-end hedge or open-ended hedge fund structure, closing books monthly, you definitely need to be doing that on a monthly basis.
Yep. Makes sense.
So when would it be appropriate to, as a fund manager, to request help from an outside valuation specialist?
Yeah, I think just in situations when you might be feeling overwhelmed, or there's just a lot of investments that you're trying to cover. You're looking at investments that were purchased a long time ago. That a long time ago might be a little bit more subjective, I guess, in that sense. I mean, you start to, I don't know if there's no industry standard for sure, but you start to think about, what things look like from a year around that mark. I would say, feel like that's somewhere around industry standard, 9 months to 12 months to 15 months, somewhere around there. You start to ask the questions, especially if something big in the industry or the market has changed that might really impact, the value of that investment. And so we can come in and try to assist there, right? It's still on kind of our clients and the fund managers to be asking the right questions and to consistently, apply those. I think the calibrated market approach, does really ask for, upfront information when you make the investment so that you can then compare on an ongoing basis to any given valuation date. Right, I think that, and there is an element of pricing, right? I think that you don't want to kind of come in and potentially price everything right away, right? There is we can, for instance, we work with clients to kind of review their portfolios, get a sense of what we think the cost might be, right, on an ongoing basis, and and really work with them on what they need in terms of their percent, portfolio covered. For us to work on, but I'd say that materiality also comes into play, right? I think that if you want to focus on or have a valuation specialist look at some of the bigger investments, just for peace of mind, that can always help too. I don't know if you have anything to add there.
No, I mean, I defer to you on most of that. From our perspective, I guess it depends on the expertise of the fund manager. Maybe they've got a lot of experience in this and they're very comfortable doing those valuations and making sure everything's set up appropriately, or maybe you've got a robust team in place within the fund that can handle all of that. But there's a lot of one-two man shops out there, and time is a constraint. And
are there any instances where you would really kind of push them towards a valuation specialist, or has that happened before? And
yeah, I mean, I would definitely think in situations where we're seeing management not performing timely valuations.
Adding stress to the timeliness of the engagement, right? Yeah.
I mean, oftentimes maybe they don't have the time, or it's not something they've had the expertise to be able to do. And we're telling them that they have to be doing this, and there's that expectation. And that's probably a great option for them to seek that resource outside of the fund.
Mm-hmm. Or I think more esoteric assets. If it's something that we can't grab a price for, a last round price, obviously that's easy for us. But the more, the less information there is, I think the more helpful for us as auditors, at least, it is to have someone like Houlihan help out.
Yeah, and then if you guys have prepared a valuation analysis, and we obviously have the ability to then work directly with you to discuss what went into that and how can we test that and what are the inputs, and then for us to be able to independently source that, that's easy to work with you guys because you have that information in hand. So it's a big benefit there as well.
Good. Yeah, I'll jot in real quick, Felicia, just to reference. I know, Matt, you've said Houlihan a couple of times. I'm sure Monica would be remiss if I didn't make sure that we said Houlihan Capital. There is another big. You're all good, but there is another big Houlihan firm out there that it gets confused sometimes. So I'll just make that. Yeah, you're all good. You're all good. I know you know what we're talking about. We're sending this out to everybody, so she probably
right. Thanks for the correction.
You're good.
All right. Well, thanks, Travis. Thanks, Joe, for your time today. That was very insightful, and I think it'll be very helpful for emerging managers or experienced managers alike. And certainly reach out to us if you have any questions on the valuation process.
Agreed. That was great. Nice talking to you both.